At our strategy, we follow a 5-phase macro framework. We track probabilities, not predictions. We focus on sequencing, not headlines. A major private credit fund just took a near 20% write-down. That does not mean collapse today, but it does signal rising stress beneath the surface. Directionally, private credit valuations moved lower. The magnitude matters because these assets rarely reprice quickly. This usually shows up early in a credit downturn. This is happening because losses were hidden in illiquid credit, and when that happens, confidence breaks before prices fully adjust. We only see this because the fund is publicly traded. Most private credit is opaque. That raises the probability similar stress exists elsewhere. A small number of loans drove most of the losses. That matters because concentration removes shock absorbers. When one deal fails, the whole structure feels it. A growing share of income came from non-cash payments. This happens when borrowers cannot pay with real money, and when that happens, reported income becomes less reliable. This aligns with phase 1 of a credit downturn. Money starts flowing out before forced selling begins. Stress rises quietly before it becomes obvious. Middle market companies feel this first, then private lenders, then funding providers if stress continues. This is why high-yield credit becomes fragile. This is why high-beta equities lose resilience. This is why optionality starts to matter more. If you want to understand these shifts earlier, not louder, subscribing helps you follow how signals connect over time. It gives you context before markets force decisions. Probability of deeper credit stress moved higher. Confidence in private credit narratives weakened. Fragility increased at the margin. This does not force immediate liquidation. It does not end risk assets overnight. Patience still matters. Quick note, this is educational macro analysis only. It is not financial advice. Over the next few months, phase 1 remains dominant. Phase 2, risk rises if withdrawals continue. Liquidity determines the pace, not the outcome. Does this reduce fragility? No. Does it increase optionality? No. Does it preserve flexibility under stress? No. This matters because trust breaks before markets clear. And when trust fades, liquidity eventually follows. We do not need to predict the timing. We just track the signals as they evolve.